Hey, good afternoon, everybody. Want to welcome you to today's event. This is the top 10 stock pick sneak peek. It's Monday, February 12th. You got John Hopkins here. Tom Bulley going to jump in just a minute. Hey, if you're new to Earnings Beats, want to welcome you for giving us a try. Of course, we have many of you been with us for a number of years and appreciate your faith in us for all these times, and just appreciate having the support of the Earnings Beats community. It's terrific. Tonight's event will be recorded like all of our webinars. If for some reason you're unable to stick around, it's not a problem. We'll make sure you get a copy, probably come out to you tonight. So no worries there. I know Tom wants to get this thing cranking right away, so let's make sure he's in the house.
Hey, good afternoon, John. Good afternoon, everybody.
Yeah, good to hear your voice. Here we are Monday. We got an event tonight. We've got one tomorrow night too. The Max Payne options, always one of my favorites. I can't wait for that one because the market's just, it's pretty much up every day, and it's going to be very interesting to see what happens to options. But I know tonight, we're focusing on, taking a look at the portfolios and getting those set up. So let me turn it over to you.
All right. Yeah, it sounds good. Yeah, the options tomorrow night's event, that is a members only event, but that's always a fun one to take a look at. We do it the Tuesday before the third Friday of every month. Third Friday, of course, is when the monthly options expire. And so we always like to take a look a few days ahead of time and just kind of see what, maybe market makers could have up their sleeve. This is going to be a really interesting one tomorrow simply because it's coinciding with a few other signals, historical signals, and some others that are suggesting that maybe we could be nearing at least maybe a short-term top. I mean, I hate to even try to call tops when you're in a almost runaway type secular bull market. A lot of secondary signals are ignored, and we just keep going higher. But tomorrow night will be more taking a look at what might happen in the very near term. Tonight's event is more of a longer term view, because essentially what we do in our portfolios is we buy into stocks and we hold them for 90 days. So essentially it's the buy and hold theory, but it's just abbreviated. So rather than buy and hold for 10, 20 years, we're just buying and holding for 90 days based on the themes that we believe are going to be in place, the market environment, individual stock selection, depending on how stocks are looking relative to their peers. We look for, relative strength leaders and so forth. So tonight's event is the sneak preview of the actual portfolio draft, which will take place next week. Now, ordinarily, what we've done in the past is these portfolios have run from the close on February 19th to the close on May 19th. And then future drafts would cover portfolios from May 19th to August 19th, and then from August 19th to November 19th, and then November 19th to February 19th. So still we're doing 4 quarters a year, but they're just not calendar quarters. And the reason we wait until the 19th is that we wait for almost all the earnings to come in. We still have a pretty good week of earnings slated this week. A couple of big reports will be out later in the week, including Cisco and Applied Materials, and some of those software and other internet names. I mean, you got like Shopify coming out later this week. Datadog, I think, comes out maybe tomorrow. You have to check the dates on these, but they're coming out this week. And so they're, and I think Cadence Design, that might be this evening. But some of these names, are still big names, but they're not the leaders like the Apples and the Microsofts and the Nvidias and so forth. So most of the names are not names that are going to really drive the market, but they could report some really good results. And, as a result, we might want to consider them as we go forward and draft our portfolio stocks for the next quarter. Now, I want to make a couple announcements tonight, and then we'll be emphasizing these throughout the week. First thing, what I am anticipating doing at this point is ending the portfolios rather than waiting for the close on the 19th. First of all, the close on the 19th would actually be Monday, which is a holiday. So technically we would be getting out on the 16th, but that is option expiration day. There is a reasonable chance that we are going to exit all of our portfolio stocks, all the not the ETF portfolio, that one's on a different time frame, but all of our individual stock portfolios, the model, the aggressive, and the income. Right now, I'm thinking about closing those out on Thursday at the close rather than Friday. I know the model portfolios had a huge quarter this quarter. Aggressive, not so much. I think part of that's been playing into that is most of the companies in the aggressive portfolio, or at least some of them, are smaller market cap companies, and they are just maybe just starting to get some love from the market. But for the last 3 months, they haven't really been in favor, and so the aggressive has continued to be a challenge for us. Income portfolio, pretty much right in line with the S&P 500, or in line, I should say. And that's always a good thing when we can get an income portfolio to keep up with the S&P 500 during a quarter when growth stocks are leading. That's a pretty good quarter for us in that portfolio. But anyway, so tonight what we're going to do is we'll talk a little bit about the results. I'll go through the 3 portfolios with you and just kind of give you kind of an up-to-date look at what's been going on in those portfolios. Then we're going to go through the big picture and a couple of areas that I think we need to be thinking about, in terms of putting together a theme and what the market may do here over the next 3 months and which types of stocks we might like to get into. We'll go through some themes that I think you need to consider. Talk a little bit about seasonal considerations as well. We do like to follow seasonal patterns to the extent that they make sense given current market conditions. And so we'll take a look at that. And then, of course, next week, I think we're going to probably schedule the actual draft for next Tuesday. So that would be the 20th. Of course, the 19th is on Monday, but it is a holiday. So we'll wait until Tuesday. So next Tuesday, 8 days from today, we will do the actual draft where I will talk about all the themes, why I went certain ways, and the actual stocks that will be in each of our portfolios for the next 90 days. We will then likely enter those portfolios probably sometime later next week. Once we get past, I don't like jumping in the first day after options expire. So we've had a recent history of kind of waiting a few days. I think we're going to do that again. So we'll probably be looking at maybe later next week, maybe around Thursday of next week after the close, lining our portfolios with the stocks that we come up with in the draft. So anyway, just wanted to go through all of that. But let's go ahead and I'm going to go get this thing started here. So just bear with me 1 second. We'll start with the results. So you should have up the portfolio performance page that we have over on our website. If you ever want to get to this page, by the way, if you go to home and you just scroll down, there will be this area where we talk about the history of success of our portfolios here. And this is the model portfolio. You can see it's been long-term, been outperforming the S&P 500 by a pretty good margin. Anyway, if you want to get more information, you click on that See More Historical Performance, and this is where it takes us to. So the portfolios were updated as of Friday. I can tell you based on today's action, the model portfolio probably lost ground to the S&P 500 to the tune of maybe 1% or maybe even a little bit more than that. The aggressive, I think, held up pretty well. Might have even outperformed the S&P 500 today, so maybe a little bit of shrinking of that underperformance. I'm looking right here at this current quarter versus the S&P this quarter. And when I say this quarter, remember, it's not calendar year. Here, we got in November 20th, so this is running from November 20th to February 19th. And then, of course, next quarter, when it starts, will be from February 19th through May 19th. Even though we, like I said, likely won't get into our stocks until maybe around the 22nd or so of next week, 22nd, maybe even the end of the week. We'll see. But here's where you can see the model portfolio this quarter having a great quarter, currently up 22.11%, or at least as of Friday's close, whereas the S&P is only up 10.5%. So we have doubled the S&P 500 in the current quarter, and we've more than doubled the S&P 500 since the fourth quarter of 2018. So model portfolio continues to perform really well, and you can see there's the since inception. 183%. S&P's gone up 87%. So following leading stocks and leading industry groups, we believe is certainly a sound strategy, one that you might consider. Aggressive portfolio, you can see longer term, still holding on, but it's been losing ground the last few quarters. I think part of it is that the small and mid caps continue to underperform. I think that could change in 2024. And if it does, I would expect that this will begin to widen this performance again. Income portfolio, it's lagged since its inception, but we've been in a secular bull market that's been favoring growth. Most of these income portfolio stocks are dividend payers that tend to be more value oriented rather than growth oriented. So this one I expect to see the income portfolio. If we have a secular bull market going on, that's when we normally would see income portfolio underperforming the S&P 500, and that's been the case. But again, that's what I would expect. Down below, we don't talk about the ETF in this particular session, but we do have a model ETF portfolio that's had a pretty good long-term track record, and it's trailing the S&P in its quarter. And I say its quarter because it's a different quarter, as you can see. We actually select the ETF stocks or the ETFs for our portfolio January, April, July, and October. So 1 month earlier than we do the stocks. Because remember, the stocks were waiting for earnings to come out. The ETFs don't have earnings. So we do it in the first calendar quarter. Or, the first calendar month of each quarter, I should say. Anyway, so let's keep looking at the results here. This is a 3-month to date look at the 11 stocks that we have in the model portfolio. And the reason the model portfolio is doing so well is because just about every stock in it is outperforming the S&P 500 over the last 3 months. Now, this 3-month return is not going to be exact because we haven't gotten to the 3-month mark yet. Today is February 12th. So we did this, probably a week. It's been a week shy of 3 months. So again, I don't have any other choices. I can't put in here two months and 3 weeks or 2 months and 3.5 weeks. I have to go with what's preset. So anyway, I think the 3-month review and performance review gives us a pretty good indication of how these stocks have performed. And you can see several of them, Palo Alto Networks, Meta Platforms, Broadcom, Costco, DraftKings. I think DraftKings reports, by the way, either tonight or maybe tomorrow. I know they report this week. Might want to check that. It might even be later in the week. I don't recall. But DraftKings, great quarter. Chipotle, great quarter. I mean, all of these are essentially doubling the S&P or close to it, maybe even tripling it or more, as was the case with PANW and META. Lulu going along for the ride the last 3 months. And then we had one software stock that's been a little bit of a thorn in our side, Duolingo, DUOL. And it's been weak. It started to strengthen recently. I believe they report this week. Well, it says 227. I'm not sure if that got moved up or not. And there's DraftKings 215. I've updated these dates, though, in my other stock charts account. So these dates may not be exact. Whoops, don't know what. Let's go back here. Accidentally clicked on something there. Anyway, these dates that I'm showing you here in a different account, they may or may not be accurate, but the if you download the current portfolios over from our website, they'll be updated. They should be updated with the most recent earnings dates. Anyway, that's the model portfolio. So we move on. to the aggressive portfolio. And you can see a number of really good performers in here in the aggressive portfolio, but unfortunately had some pretty bad, some pretty big underperformers in here as well. Tesla's certainly been wearing on this portfolio as it's continued to just meander lower and lower throughout the quarter. But overall, these are stocks that have collectively or cumulatively underperformed the S&P 500 this quarter. And then we've got the income portfolio, which again, you can see a number of them outperformed, but also we had several that didn't perform as well. Apple's actually been a little bit of an underperformer in the current quarter. So let's move on. That was a little bit of what we had in terms of the portfolios and the performance that we've seen over the last quarter. And again, next week, we will unveil the stocks that will replace those. Some of them, we may see the same stocks. Some that have continued to be very strong, continue to post great earnings and revenue numbers. It's very possible some of those do continue going forward. All right, let's move on and talk a little bit now about the big picture. Because again, when we're talking about putting together these portfolios, you've got to think first, do you think the market's going higher or lower over the next 90 days? Now, we've had a lot of big movement to the upside recently. I definitely think that we've got short-term risks because we've gone up so much. A pullback can happen anytime. But you also see in secular bull market advances, sometimes we don't go, we don't react sometimes to overbought conditions for quite a while. I know if you look at daily charts right now, you would see that the S&P 500 is very overbought. But this is a long-term 100-year monthly chart. Look at the monthly RSI. Monthly RSI is at 65 and change. We've been as high as 90. So if you're looking at the market thinking there's no way this market can go higher, I'd beg to differ, which is why we still have to recognize that we are in a secular bull market. And these types of bull market advances sometimes take no prisoners. I know people over the last year, I've been getting lots of comments. Why would you suggest that the market's going to go higher from here? We need a pullback. I mean, I've been hearing that for months and months now. And what's the market doing? It just keeps going higher, higher and higher. Occasionally we'll get that pullback or even a correction like we saw in 2023 from July through October, or even once in a while a cyclical bear market like we saw in 2022, where we went down for about 9 months from January to October of 2022. S&P was down 28%, NASDAQ was down 38%, 40%. I don't know what the number was. It was a big amount. Nobody's talking about that now. Now they're just saying everything's overpriced because we've been going up. Well, I don't know. Some of these indices have yet to make breakouts above all-time highs. The S&P has. We did see the all-time high. We were at 48.19 for a while. Needed to get through that level. We're at 5,021. I mean, we're 200 points above where we were 2 years ago. Who's to say we don't go to 5,400, 5,800, 6,200? I mean, I think we're going there. I don't think it's going to be as long as a lot of people think. But there are periods when we do at least need to recognize the possibility of a short-term pullback. But when you look at this chart, how can you think much besides bull market? I mean, those who are arguing we're in a secular bear market, I would say you need to turn your chart upside down or your computer upside down, because you're not looking at the same charts I'm looking at. Here's what a secular bear market looks like. We didn't set a new high for 13 years. Or how about this one? We went a little bit higher than 1969. We got to 1973. But from there, even from 1972, end of 72, we had 9 years before we got back up to that high. I mean, you can see this double top that formed in 1937 and 1946. From 1937, from that high We didn't see another high until 1950, 13 years later. This is what secular bear markets look like. You can see our monthly RSIs grow very weak. During secular bull market advances, you have pullbacks and you get RSIs, monthly RSIs, they'll get back to 40 or into the 40s. But you don't have the weakness last long enough to take your monthly RSIs down below 40. And we're breaking out the new highs again with the RSI climbing. This is not bear market behavior. I don't understand anyone who keeps calling and clamoring for a bear market, that we're in a bear market. They just are ignoring reality, and they're just looking for anything that will support their bearish view. It's called confirmation bias. Anything you could find. Folks that used to talk about, back at the end of 2022 and even early in 2023, when this bull market was resuming, they would talk technicals. Well, we're trading below moving averages and, you can't, we're still in a bear market. But then once you started taking out those moving averages and started breaking trend lines, downtrend lines and channel lines, and you started breaking out to the upside, all the bears stopped talking about technicals and they started talking fundamentals because technicals didn't support their argument anymore. And that's what I call confirmation bias. You just look for whatever's out there to support your bearish view. And unfortunately, that's not going to make you any money in the stock market. In fact, you're going to lose your financial wealth if you keep trying to short a bull market. But, I turned a long time ago. I'm not going to go through all of that, but it's been a couple of years now. I think time has proven me right that once you see the market fall 25%, if you get a 25% drop in the S&P 500, you basically just want to be buying. It is so rare that the S&P 500 loses much more than 25%. I think it's happened maybe 8 times in my lifetime. And I'm no spring chicken. And these secular bear markets, we've only had 2 in my lifetime. 2 secular bear markets. Here was one where we lost 50%. Here was one, actually, I think we may have lost 60%. And this one, I think we lost 50%. And I think this one we lost 50%. But those are the only 3 where if you had bought when the market was down 25%, those are the only 3 times since 1960, 1950 even. The only 3 times where if you had gotten in after a 25% drop, you still would have had some pain to deal with. 3 times in almost 75 years. But when the market's going down, people have no perspective. They believe we're just going to go to zero. And the thing I always talk about is if we go to zero, guess what? All your other investments, real estate and everything else, probably going to be collapsing as well. I mean, that's probably the one time where you probably would want to have gold. But you got to be in a market that's tumbling. I mean, we'll have so many warning signs between now and when a massive secular bear market starts. You will have to have confirmation bias on the bullish side to stick with the market when it gets into a secular bear. We don't plan to do that. We're going to look at the market objectively. But right now, how can you look at the market objectively and think that we're in a bear market? Makes no sense to me. Anyway, this is another big picture sign that I believe tells us the market is nowhere near being done going to the upside. This is the 1-year moving average of the equity only put call ratio. And the thing is, it really takes a lot to turn this ratio. And usually when you see this ratio moving up, it means the market is going from a very complacent level ultimately to a very bearish level. And when you are at an ultimate complacent level, that is where you're going to see a market top because you're running out of buyers. And when you get up here to these peaks and you start to roll over, that's where you're going to have market bottoms, or where you should stop thinking about being bearish, because the masses are bearish. There are no more sellers. So all of this whole chart, when we roll over and start moving down in this 253-day moving average of the equity only put call ratio, once we peak and start trending lower, the S&P 500 rips to the upside. Rolling over, rolling over, rolling over, rolling over, rips higher, rips higher, rips higher, rips higher. Guess what? We're rolling over, and what are we doing? We're ripping higher. Too many sellers in the market, and it's still bearish. When the market has any kind of selling whatsoever, the bears immediately start to pile into the puts again, equity puts. Now, this is the actual equity only put call ratio. And I say actual because I believe that I know that there are a lot of readings in here that are overinflated, too high. And they occurred in the fourth quarter of 2022, and they're still occurring now. In fact, it occurred today. And I'm going to show you what I'm talking about from the CBO website in just a second. But here is just, if you just pull this up on stock charts, and there's nothing wrong with the reading that stock charts is providing. Stock charts is providing exactly what they're receiving from the CBOE. It's just that this put call ratio is designed to track retail traders and what they're doing with options. It's not designed to track hedge fund managers and institutions that are all of a sudden over the last couple of years starting to use equity only puts in order to guard against downside in some individual stocks that have gone up so much. You know, the Apples, the Microsofts, the Nvidias, Amazon, Google, all the AMD, all these companies that have just made huge runs to the upside. These are the ones that are being heavily hedged by professionals. And so we're getting a lot of equity puts showing up that are not, they're not individual, they're not like you and me buying puts. And so I have to eliminate that. I have to adjust that. And if I adjust it, I do it using a user-defined index. I watch the CBOE every day. And when we have days where I can tell that a lot of hedge fund activity is taking place, I estimate what it is and I pull it out. And I think my readings on the CPCE in my user-defined index are much, much more reliable in terms of following what's going on in the retail trader market. So anyway, here's my adjusted. So if you look at these two peaks, and I only go back here over the last couple of years because I didn't go back and adjust. I didn't really need to go back and adjust because we never had these crazy readings before. So it was really in 2022 that I started doing this user-defined index, and I update it every day now. But if you look at these two peaks, see how the 253-day moving average of the CPCE comes in at 0.69. If I go back to that prior one, the double top occurs over 0.72. And the reason those numbers are higher is because it's including the puts and that put call ratio that includes those hedge fund puts or the hedging that they do. And that's not really what we want to incorporate in this chart again. So that's the difference. Now let me show you what happened today. Here's the equity options over at the CBOE. So if you go to the main page on the CBOE and you come over here, click on data and access, go down to market statistics and then market volume and scroll down. There's the total puts and calls, index options, and here is equity only. Now, I want you to look at these readings are half hour. It says 9 and 9:30, but these are central times. So this is going to be 10 and 10:30 Eastern. So it's the first half hour of the market right here, and then the second half hour. Look at the reading that we had starting off today. 0.59. That's exactly kind of what I would have expected. Market strong. We're, not really seeing any selling. And as a result, we're seeing more calls being bought than puts. And this ratio is puts divided by calls. 227,000 divided by 383,000 gives us 0.59. Look at what happened from 10 a.m. Eastern to 10:30. These first two readings. Look at the puts go from 227,000 to 1,028,000. That's an 800,000 jump in equity puts. But look at the calls. 383,000 to 619. 236,000. 236,000 calls. 800,000 puts. 800 divided by 236 is probably something like 3.5. So your put call ratio today from 10 a.m. to 10:30 was 3.5. Now, I can tell you from having tracked this for many, many years, we didn't get readings like that in the midst of the financial crisis. And I want to show you today's chart between 10 and 10:30 a.m. The S&P 500 was right at about flat, and we started gaining ground to 10:30. This isn't, you and I don't panic when the market's going up, setting a new all-time high. So where are all these puts coming from? They're coming from hedge funds who are just simply trying to protect profits that they've made on some of these large cap names that have just been going straight up. And so what I'll do is just estimate. I know that retail traders did not buy 800,000 equity puts in this half hour. The first half hour was 227,000 versus 383. And you can see the second half hour of calls, the number came down to 236, which is roughly, I don't know, maybe about 60% of the number of calls that were bought in the first half hour. So I think a reasonable number would be maybe 60% of the puts. And then what I do is I take that difference. If it's 60% of the puts, that would be what, roughly 100 and maybe 140,000. And then I take 227,000 and 140,000. That would be 367,000. That means this number right here is overstated by probably about 660,000. So what I end up doing is I adjust this final number here by 660,000. And I come up and I recalculate this number because it's not 0.99, not the retail trader. Once you take that out, it's probably going to be more like 0.75. And that's the number I post in the equity only put call. That's going to be what I'm going to do in my user defined index. So again, this is a big picture. I know I'm getting into a tangent here, off onto a tangent, but it's always, every time I explain the equity only put call ratio, I feel like I know that there are new people in the room, and I need to explain why I'm not just taking the stock charts number and going with that. I use a user defined index to come up with my own calculations that I believe more accurately tracks what's going on in the retail world. So what I'm seeing is here's the stock charts number, which is rolling over and starting to go down. But here's what I'm using. And there's your double top. We definitely topped back here in May of last year. And I suspect with the next move to the upside, which I think the next big advance, I mean, maybe we just keep going from where we are. But if we do pull back February, March, like is more typical of a normal year, then I would think maybe the run that we see into April earnings, I think that's going to be one that that'll start replacing last year's daily equity put call ratio readings. And I think that's when you're going to start to see this really make a big drive to the downside, and why I think we're probably going to have a big rally over the summer. One of the reasons. So anyway, this is still favoring the bulls going into the next quarter. So I just wanted to kind of point that out. All right, let's keep moving. So here's inflation. This is another thing we need to be at least watching. Personally, I don't think there's an inflation problem at all. And what I've done here is I've put the S&P 500 on the top. I have the core consumer price index, core CPI, with a 1 month rate of change here. So this is giving us the 1 month. Here's the over on the left side. You can see, rising 0.2%, 0.4%, 6, 8, a full percentage point. You can see we haven't seen that really since back in the 1970s, 1980s. But coming out of the pandemic, 1 year after the pandemic started, because we shut down everything, all of a sudden we had demand picking up. We didn't have enough supply and prices took off. And so 1 year from the pandemic is when we started getting the high inflation readings. And since then, this is the 1 month change in the core inflation rate. I mean, do you see anything other than a downtrend for the last three years? We've just been slowly downtrending, working our way back. This is what I consider like a normal range. For 20 years, 25, maybe even 30 years, these monthly readings basically came in somewhere between flat and 0.4%. That's kind of the normal. And we've been working our way, and now we're back down into the normal, where I think our last 5 or 6 readings have now come in at or below 0.4. And as we continue to drop, which I believe we will, tomorrow's reading, who knows where we're going to come out? I guess it's a big guess. The estimate is 0.3%. I think we're going to come in lower. We'll see. But if we do, then we'll see this take another drop. And if we do, also, well, we're going to see this drop anyway, because I think last year we had like 0.6% that we'll be replacing with this month's reading, which is 0.3. Actually, last year might have been 0.5. We'd have to go back and look. It would be, I don't know, one of these up in here, which is going to be somewhere around 0.5 to 0.6%. That's one that's going to fall off down here on the 12-month rate of change. And then the new month will obviously be added. So whatever month was 13 months ago gets dropped off and the new month gets added. And we're probably going to just keep falling. So we're expected to see this fall to about 3.7%. I wouldn't be surprised to see 3.6. So inflation keeps dropping. Now, one thing I'll point out, and I've pointed this out for a long, long time, when inflation peaks and rolls over, it's awesome news for stocks. And just go back and look at history. Mid-1970s, big drop. S&P 500, big gain. 80 through 83, big drop. 80 through 83, big gain during that period. 84, mid-84 through late 86. We can see inflation wasn't really a problem then, but it was rolling over. What did the S&P 500 do? Went higher. How about when we fell from 6% in 1991 down to about 2% in 1999? That coincided with one of the biggest bull market runs in history. Then after going sideways mostly for quite a while, then we had the latest spike, which was pandemic driven. And since we have peaked and since we have rolled over, what's the stock market doing? Going a lot higher, right? Almost perfect to the bottom was the top on inflation. And so those are things that I've talked about and I kept repeating over and over and over again. Bears don't want to listen to it. They've got their own agenda. They're not going to be convinced of anything, and they just have to sit on the bearish side, I guess. I don't know. But let's keep moving. Got more to talk about here. Here was one article that I wrote back on November 20th, 2023. I was getting a lot of comments back then about, how can you be bullish? Why would you encourage folks to jump in at the top? Well, as we all know, back in November, that was not the top at all. We had quite a run since November 20th. But one thing I talked about in this report, I think this was one of the weekly market reports that I had just allowed folks over at Stock Charts to take a look at, just so you can see what we do. And here was inflation, talking about inflation. I was talking about it back then. I've been talking about it for probably over a year or two at this point. But same thing I'm talking about tonight. There's your 12-month rate of change. Here were your 1 month. What we're doing right now is we're replacing all of these higher readings with lower readings that are more in the normal range. This is going to keep coming down. And I could spend another half hour talking about the Fed chief and their whole policy, but they started a couple years ago just saying all we want to see is just, the fact that inflation's starting to roll over. And now here they are, Powell still 2 years later saying, whoa, we just want to make sure that it's still getting down to our target level. A lot of transparency in this Fed. Sarcasm intended there. So, that's another thing, though, that we've got to be aware of. Inflation is going to continue. I think lower and lower inflation is going to continue to drive more and more folks into stocks. And the reason is very simple. When inflation's coming down, it reduces the pressure on the Fed to raise rates. They've stopped. And now they're just waiting and pausing to start cutting rates, but it's coming. We're going to have rates cut. Probably will be in June. That's my guess. That's when I think it starts. And it might be faster than people think. It may not just be quarter point here, quarter point there. If inflation's completely in check, and if we see any signs that the GDP is slowing a little bit, I think you're going to see the Fed aggressively cutting because they don't have to worry about inflation at that point. So I think we're going to get that soft landing. I've been saying it for a while. I think I wrote about it probably 4, 5, 6 months ago, talking about the soft landing and the fact that I thought we were well on our way to getting it. So I do think it's going to play out well for stocks, and I think we go higher later in the year. So on this, here's the CPI, and I usually get my economic reports over at econoday.com. But here's the CPI. This is what we're expecting. Let me make this a little bigger so everybody can see it. But here's your month over month tomorrow. So the January reading comes out in February, and this is what we're expecting. That's the headline number. Now, if we exclude food and energy, so we're looking at core CPI, there's 0.3 is the consensus. The range is 0.2 to 0.3. I think we're probably going to come in on the 0.2 side, maybe even 0.1. I think we might get a melt up tomorrow if we get a 0.1 reading. But I think it could be 0.2. And if you look year over year, 3.9 is what I was just showing you. That's where we are now. That was the prior. If we just get what's expected, hold on a second. Yeah, if we just get what's expected, that 0.3, we come down to 3.7. But what if we come in at 0.2? Then we're going to be looking at 3.6. I guess the question for the Fed is, how low do we need to go before we're comfortably within the Fed's range? Do we need to crack 3? Do we need to get down to 2.9? Do we need to see a print of 2.0, or is there going to be another excuse at that point? I don't know. But anyway, 3.7 is that's what we're looking for tomorrow. So even if we come in line at 0.3, we're still seeing that annual rate of inflation coming down. The only way we stay at 3.9 is if this number comes in 0.5. Market wouldn't like that, by the way. I don't think it's happening. But yeah, that would be a little bit of a surprise. Probably see some gains erased pretty quickly. But again, I think it's going to come in lower than expected. And I wouldn't be surprised to see another rally tomorrow, but we'll see. All right, 10-year Treasury yield. So 10-year Treasury yield, of course, this is going to be impacted in the morning by the inflation numbers that come out. We're sitting at a key resistance level. Once we hit the low just below 380 and we rebounded to the 50-day moving average and touched 420, that was the range. At that point, I felt like the range was established. We went back down, got almost to 380, and then went back up. Now we're back to 420. If the inflation number is lower than expected tomorrow, I think money pours back into bonds, sending yields back down. I wouldn't be surprised if the number's lower, if the inflation number is lower than expected. I mean, I could see 20 basis points off of the 10-year Treasury yield tomorrow. I wouldn't be shocked. But again, we'll see what happens tomorrow morning. I can only make a couple of educated guesses, but we don't know what's going to happen until we see it. All right, another theme that I really like about the market right now is here's your S&P 500 rallying. Here's the QQQ relative to the SPY. What are we doing? Higher highs, higher lows. How about the XLY, XLP? Higher high, higher low. We're turning back up again. Just setting new highs. IWF, IWD, large cap growth versus large cap value, moving to new highs. The Dow Jones US large cap growth index versus value index. This is just another way of looking at the IWF, IWD. You can see that they're pretty similar, but it's just a couple of different indexes that track growth, large cap growth versus large cap value. That also going higher. How about mid cap growth versus mid cap value? Going higher. Small cap growth versus small cap value, going higher. Transports versus utilities, going higher. Every one of my key sustainability ratios, and when I say sustainability ratio, I'm looking for anything that suggests that money is rotating in more defensive fashion, because that would put me on alert that, hey, even though we're seeing the S&P 500 move higher, we're seeing maybe a little bit of bearish rotation. And when I look across here, I just don't see it. So for anybody who wants to argue about a recession in 2024, I'm just going to ask you, why is all the big money and all the big firms on Wall Street continuing to favor growth stocks? Just answer that one question. Because the stock market and Wall Street looks ahead 6 to 9 months. And if they're seeing contraction in the economy, there is no reason whatsoever to buy growth stocks over value. Zero. Growth stocks will get hammered during a recession. So why are these growth stocks and all these growth ratios, why are they all going up right now and supporting the move up on the S&P 500? I can tell you why. At least the story it's telling me is that we've got a good economy ahead. We got falling inflation ahead. We got nirvana for equities ahead. And that's the way all the ratios are lining up. So are we overbought? Yes. Do we have a negative divergence? Yes. Even though looks like might be eliminated if we keep going higher. But yeah, right now there's a negative divergence still in place. Yes, we're overbought. Yes, the end of the first half of the first quarter is coming up. That's usually the bullish part of the quarter. Next week, we start the second half. Actually, this Friday starts the second half of the first quarter, which is much, much less bullish. Much, much less bullish. I think the NASDAQ, I just showed this recently, but I believe it was the first half of the first quarter. The annualized return on the NASDAQ is like 30%. And you get to the second half of the first quarter, February 16th to March 31st, and it's flat. And that goes back 45 years, 44 years. That's pretty remarkable discrepancy in performance between the first half of the first quarter and the second half of the first quarter. So listen, we've got signs that are suggesting that maybe this is a little long in the tooth to the upside. But we do need to see some confirmation in terms of price. And we haven't gotten any of that yet. None of it. And again, like I said, money's still rotating into growth versus value. So it's a balance. I mean, do you go with the number one indicator in the market, which in my opinion is price and volume? Or do you start looking more at these secondary indicators? I mean, they're starting to gather, they're starting to pick up a little steam. It's kind of like, that one cloud that was out in the distance all of a sudden now is being joined by some other clouds, and it's starting to maybe get a little bit darker in the out on the horizon. But it certainly hasn't started raining yet. So do you stick with the market on the long side, or do you start anticipating a decline? That's the question everybody has to answer for themselves. But for me, I really find it difficult. What I am hoping to see is the 5-day moving average of the equity only put call ratio. If we keep going up and my adjusted CPCE readings come in, where I get a 5-day reading down around 0.55, then we could have some trouble. And I'm going to show you that chart. Here's the 5-day moving average that I calculate. And let me just put this out, much bigger chart here so everybody can see it. But right now we're sitting in a neutral reading. Friday's reading was 0.48. Today, I mean, it was 0.99 according to the CBOE. But I calculate a number that's much lower. And if we keep going up and we get more readings, lower readings, like in that 0.48 range, in the 40s or maybe in the 50s, possibly by the end of the week, maybe we're seeing this start to move back down closer to 0.55 or so. Because when we get a peak, or a bottom, I should say, of the 5-day moving average, I want you to look at it here. This peak coincides with that, or this bottom coincides with this market top. This bottom coincides with this market top. This bottom coincides with this market top. Here, 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 here. And then actually we had a little bit over here while we were going sideways. Probably just didn't annotate that more recently, but that could be annotated with these tops, sideways action. And now here we are going straight up, but this is still neutral. Again, watch for this to come down into this range. That, I think, is going to give us a little bit more of a signal we need to pay attention to, because you can see how accurate this number can be. All right. Here, I started looking at some seasonality. Here's the large cap growth versus value. And I go back from 2013 to 2024. So that's basically the secular bull market. And you can see growth versus value. The odds of the IWF outperforming the IWD over the next 3 months continues to go down. So, but the average is still outperformance in favor of growth. So, I can definitely see where, February and March maybe aren't going to be as strong as what we saw in January and the first half of February. And seasonally, that kind of goes along, kind of shows us that that's the case. I will also mention that the month of April coming up, not too far, or not in the not too distant future, semiconductors can't stand the month of April. It's like their kryptonite relative to just about any other month. I mean, if we look at the DJUSSC and we go back 12 months, or 12 years, I mean, look at April relative to May. I mean, February is fine, March is fine, April's horrible, and April's a good month too. Look at this. Let me show you semiconductors relative to the S&P 500 over the last 12 years. They've averaged underperforming the S&P by almost 3 percentage points, and they've outperformed the S&P roughly 1/4 of these last 12 years in the month of April. So maybe like 3 out of 12 years. I mean, that's actually probably 3 out of 11, because we haven't had a year yet in 2024. We haven't had an April yet in 2024. So it's probably 3 out of 11. So it means 8 times out of 11, Semiconductors have underperformed in April. So are the semiconductors going to continue to still remain fairly strong until we move into April? I mean, then you can see in May, they take off again. May, this is the best month for semiconductors. And I've noticed in the past, the second month of calendar quarters is when we tend to see strong semiconductor performance. February, May, and you can see February averages outperforming 2.7 percentage points, May 4.9, August 0.5, and November 4.2. February, May, August, and November account for the lion's share of relative outperformance by semiconductors. Well, we're almost halfway through February. So semiconductors probably getting a little bit long in the tooth here, their rally anyway. And as we go into March, we see performance drop a little bit, and in April for sure. So we might have some rough periods ahead still with the semiconductors. And that's something I'll be taking into account. And as is all of the, as I look through all of the performance, I mean, technology, let me show you, or I can't show you, but I can tell you. Technology during this secular bull market has outperformed the S&P 500 by 1 percentage point in February on average and 1.1% in March, but then it trails by 0.3% in April. Another thing to consider too with these portfolios, listen, we put these portfolios together and we hold them for 90 days, but that doesn't mean our members have to do it. I'm going to give you some numbers here, which would suggest that maybe in March, you might want to, I mean, even if you're following the portfolios, you might want to consider the fact that defensive groups tend to be much, much stronger. Let me show you the XLU over the last, and then we'll compare it to the S&P 500. And let's just go back like the last 12 years. Look at March. Utilities have outperformed by an average of almost 3%. And almost every year it happens. So utilities love the month of March. How about real estate? Same 12 years. March, only 55%, but does outperform by 1.2 percentage points on average. How about staples? Last 12 years, March, staples outperforms roughly 2/3 of the time and by an average of 1.3 percentage points. So you have to understand that you've got different periods of the year, especially the third month of calendar quarters tends to favor the defensive stocks. I mean, you can see September favoring staples, December favoring staples, June, not as much, but we get a little bit of average outperformance. Add those up, March, June, September, and December. If we take that out of the equation, you pretty much don't want to be in the XLP any other time of the year. It's the third month of each calendar quarter. Why? Why would that be? Well, it normally would be because earnings season has ended. It's all in our rearview mirror at that point. We're now a month away before it starts picking up again in April. So the high growth companies that just went rocketing up in the first couple months, heading into earnings and then after earnings, take a breather and money rotates over into defensive areas the third month of each calendar quarter. That's essentially how the market plays out. And you got to be aware of it. So if you're holding on to the portfolios and we're doing really well heading into March, you might want to just either move a little bit more towards some of these defensive areas, or, maybe don't take any chance and move to cash. I mean, it's completely up to you how you react to the stuff. I just point out how the market works. And these are some things that we'll consider when we try to figure out how we want to put these portfolios together. The themes are just as important as, everything else. Now, if I go back and I show you, let's look at some different, like here, I just put together like an earnings AD, and I put together 30 stocks in here that I really like based on how they just recently traded after earnings. And the horizontal lines that come in on these earnings AD chart lists, by the way, this is where we opened the day after earnings came out. Or the earnings might have been out that morning, but this is the first market open since the earnings were released, whether it was from the prior afternoon or the current morning. In this case, I don't remember when ARM reported, probably in the afternoon the prior day. But here was the open after earnings. And look at this action. I mean, today the stock was up 29% in one day. And there are others like it. I mean, actually, if we pull up the view all summary, we can look at how all of them did today, intraday. So it's one day, 29%. CLSK was up 14%. You can see the sector and the industry group that they're in. And then there were a couple that were down, but for the most part, things were up onto. This was actually a stock I traded day before yesterday. And I'll show you why I traded it. I'm going to shorten it. So if you look here, I'm going to inspect, but you notice here the high open was 170.79. And when we came and had the earnings report, we opened at 171.01. We opened above resistance, which is usually a bullish sign for me. And then I watched, the stock went down and hit the 20-day moving average. That's where I probably should have gotten in, but I waited. I ended up, when it came back up, I think I ended up getting in around 169 or 170. And I got out the close, or right before the close. I think I got out like a 179. So I didn't get everything I could have gotten out of that day. But that open above resistance told me that I should probably still remain bullish, even though it was down intraday. Because if you look at an intraday 10-minute, 5-day chart, look at what it did. After opening up, look at what happened. Came all the way back down to 162. It was still in an uptrend. We had a higher high. Even this came in at a much higher low. So we had a higher high and higher low. But when we gap up, what are market makers doing? They're shorting. So a lot of times we'll get that gap fill. And then once we did that, and probably a lot of folks that got in at the open, panicked, sold $10 cheaper. And then once all that happened, then the stock took back off again to the upside. But it was right in here, or maybe right in here, maybe, that I decided I was going to go ahead and jump in. And it continued up pretty much throughout the rest of the day. But today it was down. This is a stock maybe I probably should have gotten back into today. I wouldn't be surprised to see another gap up tomorrow and break back up above 180. But this is in that earnings AD list. And so, I mean, MUSA, I really like this one. It pulled back, but came back up, closed near the high of the day. So this is one that early this morning was down and then rallied back. I think WMS did the same thing. It's another one I think that's on this list. But yeah, morning down. Didn't go below the prior day's low, but morning was down, then rallied back, closed near the high of the day. This is a list that I'll be looking at quite often for trading. And when we do our Wednesday live trading session for members, I'll probably be pulling up this chart list quite a bit, looking for some morning trades. And there's WMS, by the way, so it also was on this list. Anyway, where we get most of our portfolio stocks, though, what I wanted to show you was our strong earnings chart list. This is where, if you go back, and again, we could pull them all up. There's a bunch of stocks on here. And we can see how they perform today. And there again, ARM and CLSK both on this list as well. And then you can see a bunch that were up. And then I'm sure there were also a bunch that were down, somewhere down here. Go all the way to the bottom. So there's one stock that was down 10%, Monday.com. GTLB, this is actually one that was pretty hot for a while. Scooter's 96. Sometimes I like to use that weakness to get back in. Here's one I think if it gets to the 20-day, might see it tomorrow. GTLB could be a trade, but anyway, I'm getting a little bit outside of what we do with these portfolios, but all the portfolio stocks that will come from our strong earnings chart list, and that was the key. I just like stocks that are reporting good fundamental numbers and also showing great technical leadership as well. So I'll be happy to answer any questions, John. If there's questions, fire away. Or I can take a look at the questions. I don't know. Maybe John has stepped out.
Oh, I'm here.
Oh, okay.
So why would we sell all holdings on Tuesday, February 15th, and not know what Tom suggests until Tuesday, February 20th, the market holiday? Some of the prior quarters might be included in the new suggestions.
Well, I mean, the idea of getting out on the 15th is that we know historically, second quarter, or the second half of the first quarter is not as bullish as the first half. We know options are expiring on Friday. We know the worst day of all calendar months is the day after options expired, which will be Tuesday. So I don't want to jump into new portfolio stocks when they're very extended, very overbought, and subject to possible market maker manipulation here right around options expiration. So that's the reason why we have tended to get out and just kind of sit in cash. If the market pulls back, it's a win for us because we're outperforming the market by sitting in cash. I mean, if we're going to, get rid of one group of stocks and get into another, why not try to get in when it is most favorable to us based on historical patterns? So that's the reason we started doing this maybe in the last 2 or 3 quarters, and I think it's helped us a little bit in our portfolio returns. I mean, there's no guarantee. Maybe the market just takes off Friday and into next week, and maybe we'll have to get in at higher prices. That's a risk that we have to take. But again, I'm not going to be at anybody's computer holding their fingers down to the buy buttons on any of these stocks. I mean, everybody's free to trade them or not trade them. We're not registered investment advisors. I am not recommending. I'm not advising because I'm not licensed to do those things. I'm educating. And I think pretty much everything I've talked about in this session has been educational in nature. What you do with this education is completely up to you. The problem is that there are risks involved, and everybody has different risk tolerance. And so I go over this a lot. There is nothing I can do that is one size fits all in terms of risk for everybody. Everybody's got different risk tolerance levels. There's some people that might look at that earnings AD chart list that I was just showing you with the 30 stocks on it, and you look at a stock like ARM, which was up 30% today, and they'd be like, there is no way I would ever buy a stock that's that volatile. Perfectly okay. That's, you're identifying your own risk tolerance, which is important. I mean, if you're getting into a stock that could take a big hit and you're not willing to do it, then you shouldn't do it. But there are others that treat the stock market a little bit like a casino, and they like those high flyers. And how could we at Earnings Beats possibly come up with something that's going to cater to both folks with 2 different tolerance, risk tolerance levels? So we can just educate. I can sit there and tell you, okay, these are really aggressive. This is a little bit more conservative. And, our members can take all that information, then digest it and figure out what they want to do in their trading. That's really what we're trying to do. We're providing overall market guidance. We provide market education and market research. That's what we do. And beyond that, whether you buy, sell, is completely up to you, but I think you're doing it with a lot more knowledge when you have Earnings Beats kind of coaching, or however you view it, from the sidelines. And anyways, that's my answer to that one.
That's it, Tom.
That was it?
That's it.
All right, awesome. So next week, by the way, if you are new to Earnings Beats, because this is open to the public today, But if you are new to earnings beats, we do have a 30-day free trial. So you can always just come in, check us out for 30 days, no commitment. You have to provide a credit card so we can get you set up in the system, but we will reach out to you at the end of the 30 days to let you know that your trial is expiring. And then it's up to you as to whether or not you, you're going to renew automatically if you don't cancel. But taking this 30-day trial, number one, you'll be around for next week's portfolio draft. You'll know the stocks that we're putting in our 3 portfolios. All of our trading rooms, all of our chart list, everything will be, available for you for the next 30 days at no cost. So you can see exactly what we do. I think our service is second to none. I'm sure I'm a little biased there, but I know what most folks do in their services, and ours is a lot different. It's really centered around research and education. But anyway, that's it for me. Appreciate everybody coming in, but definitely give that 30-day trial a thought if you're not already a member. And for those of you that are current members in here, we always love to have you in here. Thanks for your support. That's it for me. Have a great evening, everybody. I'll be back tomorrow morning for your next Trading Places live show. And then, of course, tomorrow afternoon, we'll be having our Max Payne webinar, the Tuesday before the third Friday. And I think you're going to see a lot of crazy in the money call premium. We'll talk about that more tomorrow afternoon. Have a great night, everybody. Happy trading.